time. Joining us now is Citi's Andrew Hollenhorst alongside Jim Bianco of Bianco Research. Andrew, you've had the benefit of extra time to go through this. Your take on what we learned 15 minutes ago.
It's interesting. It's interesting because of what did not change. This seems to have been very carefully put together so as not to send a dovish message like Diane was talking about. Really notable, I think, that the Fed could have taken the opportunity to say, headline inflation has come down, core measures are still elevated, but they left that statement unchanged. It still just says inflation is elevated. On the growth side, what was modest growth is now characterized as moderate growth. So just the tiniest inkling of a little bit of hawkishness that's creeping into this statement, at least relative to expectations.
Some of that little bit of hawkishness on the street, folks, came from Jim Bianco, who joins us right now in Chicago. Jim Bianco, I look at where you are in the bombshell you had a number of weeks ago of saying maybe we're a little more sticky than we actually think we are. Where is Jerome Powell's presumed R-starred path at this press conference? The zeitgeist is he's down to 2%. Things are normal. We're going to get back to normal. I'm going to suggest you disagree with that.
Yeah, I do. I do think that we might be on a year-over-year basis looking at the lows of the year in inflation, in June, and that we're going to see there's going to be a big base effect for the rest of the summer, and it's going to start to drift towards 4, and we'll be lucky to be back even close to 3 by the end of the year. And that will bring up the big question is the long run, rate of inflation, is it 2 or is it 2.5 or 3? And remember, the Fed has already told us that neutral rate is 50 basis points above the long run inflation rate. So if it's 2.5, then neutral is 3. And if the yield curve goes back to some normal level, which is around 150 basis points, you're talking about a fair value for the 10-year at 4.5. And we're at 390 right now. So we're a little bit low. And it all comes back to this whole argument about inflation and where's inflation going to go. And I've been arguing, the big fancy word, that this is a post-pandemic economy. That means that all the models on how inflation are going to work haven't worked since 2020. Right. And we have to write some new models on how it's going to work. Work from home being one big thing about how major that the labor market has changed, and a lot of other things too, like with the supply chain. And I think we're going to wind up with stickier inflation.
And Lisa, this is critical because this is what our booking team, we've got the morning crew and the afternoon crew that do it 24/7 for us. And to see the setup here of Hollenhorst, Michael, and Bianco and the collegial disagreements they have is the heart of the matter, and how it rolls back over into whatever we're going to make or lose in the stock market.
Which is the reason why I'm kind of shocked that this was an 11-0 decision. There was no dissent. I agree with that strongly. Given the fact that there are such divergent opinions. This delusion of unanimity is just, I don't know, the British do this better than we do. Well, I guess that's what I would ask you, Andrew. Do you think that it undermines the Fed to have unanimity at a time where there clearly is not unanimity in markets or on the Fed?
Look, I share with you the surprise that we would have no differences of opinion at this point. I think Powell has been somewhat masterful in terms of getting these decisions to be unanimous. But we saw that sometimes coming at the cost of clarity. I think that's what happened in June, where we had this strange decision not to raise rates, but to signal that it would be appropriate to raise rates another 50 basis points. So as you try to keep that committee together and get unanimity, it's a little bit troubling in terms of getting clarity in terms of the communication.
Bob, your take on this in terms of whether it's helpful or harmful to have unanimity at a junction that is clearly so fraught with disagreement on the street and at the Fed?
I don't think the unanimity is the accurate portrayal of what actually occurred in the meeting. And I'm dying for Bullard to go into private life so that we can ask him these questions. I think what they did is they locked arms. As Diane's pointed out many times, they are concerned about financial conditions easing. This is another way to try to stop that from happening.
I look, Bob, at this. I can just see you with a speech with Bullard down in Purdue. What a debate that would be right now as he moves from the St. Louis Fed to Purdue. That goes to the dots and the dispersion. This was a Fed. Let's speak for those that don't keep score on this, like I don't keep score on this. Was this a dot-free meeting? How important is the setup to the next dispersion, the next theater of dots? Or are we beyond that?
We're living in an AI world now. What are we doing? Not doing dots and summary of economic projections at every meeting. Let's do it and indicate more about what the Fed is thinking. I think
you want more transparency.
If you're going to do it, want to know, and I think particularly, not usually, but after the last meeting, we've all talked about what were they doing? They didn't hike in June, but they indicated another 50.
That was odd.
If I were Mike McKee, I would ask Chair Powell, what about the dots and the summary of economic projections from the last meeting? Do you still stand by those, or would have anything changed?
Well, it's unclear which dot belongs to which policymaker. Bostic might have been one of those that would dissent today. Bostic doesn't have a vote on the committee at the moment. Bullard doesn't have a vote on the committee either. The Board of Governors, that would be where my issue is, because the Board of Governors, even if they believe that they shouldn't be doing one thing, they all vote as a committee, as one. So I just wonder, Andrew, how much we should read into the lack of dissent at today's meeting, and that maybe the September one is the one where it gets a little bit more fiery.
Yeah, I think it's definitely the case that there's a lot more going on behind the scenes here in terms of some disagreement. We saw some of that in the minutes to the June meeting. So there are real differences of opinion. And I think, like Diane, like the others were talking about earlier, this could really get interesting in September. In September, they'll have to make a decision. First, whether to hike rates. I think they probably won't because the inflation data has been softer. But then what do you do with those dots? Are you still showing that you're going to hike again this year? That would imply a hike in November. Are you then indicating that that's the last hike of the cycle if we see inflation picking up further? And I think that the risks are that it will as we get towards the end of the year. So it gets really tricky as they get to that September meeting. And then December, dots again. Are you showing no further hikes? Are you showing cuts? What do financial conditions do with that?
Jim, come back in here because you were talking about how models are broken and they're not really forecasting inflation in any kind of accurate way. What is the compass for the Fed? Do we have a clear sense of what data dependency means in the post-pandemic era, where suddenly the data is not a reliable forward-looking indicator?
To be frank, no, we don't. And that has been one of the bigger problems, is that in a data-dependent world, what the Fed is trying to do is they're trying to divorce themselves from any theory that of how the economy and inflation is supposed to work, and they're supposed to react to the data. And then we get what we've had in the last 2 months. They paused in June. We got a big miss in the inflation report. Year over year went from 4 to 3, and then they hiked. And so I'm not exactly sure why they paused and why they hiked, and what they're going to do next based on their recent action, which is why I would underscore what Bob said, that, Mike McKee's got to ask, what are you doing? And what is driving these decisions?
Right.
You pause, and then we get good inflation data, and then you hike. So there's a big confusion going on out there right now. And it's all part of the modeling that we've seen in the market. It's been very difficult to figure it out.
I want to set up one question here and give it back to John to get to the press conference in 6 minutes. I want to go to Bianco, and then Hollenhorst, and then Michael here. I want to know your 12-month forward real GDP as you also violently disagree on inflation. Jim Bianco, 12 months forward real GDP. What's the statistic?
About 1.25 or so.
Okay. Hollenhorst?
I think we will have seen a decline. I think we'll have seen a recession by then, so we'll be sub 1% GDP.
Ferroli, Casman, what do they say? We'll fold it in.
I think we'll have passed through -1.5% to -2% real GDP.
This is not, John, in the American zeitgeist right now. The combination of those three opinions wrapped around their different inflation outlooks, this is removed from Meta, removed from Google.
We can't let them go just yet, Tom. There's still 7 minutes before the...
No, I know, but you're going to, I got to get back to Tottenham. I'm just trying to see what the future is.
You just want me to speak for 7 minutes now.
Yeah, I got to read about Tottenham.
As you were talking about that, I was noticing Mercedes-Benz raised their full-year guidance. I'm just sitting there thinking, hike again, 50 basis points. Mercedes still getting it done.
Coca-Cola too.
Yeah, Jim, let's talk about that, though. In all seriousness, who's paying these high rates? Where are they biting?
That's a good question. I think that they're biting at the business level, that they're wanting up to pay higher rates. They're definitely biting at the residential real estate level. You've seen a wholesale change in the way that the residential real estate market, existing homes don't move, and we've been trying to fill the gap with new construction because we've got a multi-year low in the volume of existing homes. So they've been biting there as well. Where they're not biting, by the way, seems to be in the cost of capital in the stock market. That doesn't seem to be bothered by it at all. So it's unclear as to where it is. And that might be leading to an idea that maybe all we've done with a 500 basis point plus rise in rates is just pretty much track neutral. And we're not really that restrictive, which is why we're not seeing these high rates hurt the economy as much as we thought.
Bob Michael, what would you say back to that?
I think it's biting in a lot of places. I think it is biting in the corporate world. You look at bank loans, defaults are rising pretty sharply. You look at the private credit markets, talk to people in there are real tremors there about what's happening in terms of exchanges and extensions. You start looking at, we didn't talk about central business district office space. That's still out there, unoccupied. That's owned in places. We saw that in Goldman's earnings. That has yet to be reconciled. So it's biting hard. We talked a lot about the consumer. They are really struggling.
Would you like to talk more about Goldman earnings? No, take a pass on that. I thought you might. Andrew Hollenhorst. Bob went there. Bob went there. Come on. Bob went there. I said Goldman. No. Andrew, I think we need to spend a bit more time talking about this. Just how much of the disinflation that we've seen recently is a consequence of the tightening cycle of the last year? How do you know? How do you identify that kind of thing?
Well, I think that's partly why the Fed's in a little bit of a difficult position here, because they've taken some credit for some disinflation that they did not have a lot to do with, which is the decline in energy prices, which is the decline in food prices. And then we're seeing, as we head into this meeting, we're having very large daily increases in gasoline prices. So it's certainly not going to feel to a lot of people like inflation really has been conquered. Now, somewhere where they do have a direct effect is on the housing sector, shelter inflation. And again, though, I would raise a caution there that we're kind of in this narrative that shelter prices are slowing, and they are. There's a lag that's introduced into the way that the data are put together. So those shelter prices will slow in official inflation statistics, but look at the reading from Case-Shiller. Look at what we're seeing in the real-time housing price data. Those house prices are rising quickly now. So there's some real upside risk to inflation, which would kind of go back to Jim's point that maybe 5%, 5.5% policy rates aren't the amount of restraint on the housing sector, at least that we thought it was going to be.
So I promise you this really is the final round of questions for all three of you, with the news conference about 3 or 4 minutes away. We need to get your questions for Chairman Powell. We touched on it briefly. You don't get to repeat that twice. Jim, what would you ask the chairman today in about 4 minutes?
Basically, what has been driving the decision-making to pause and to hike. I kind of said that earlier, but it does drive at the confusion as to what is really on top of mind for the Federal Reserve.
Andrew, what about you?
I would ask about the rebound in the housing sector. Prices, growth, upside risk to both.
Well, Michael?
I'd ask what range of inflation and growth metrics are they using, and what levels would they look at for them to, one, pause permanently, and secondly, cut rates?
What would they tolerate? I've heard that from PIMCO, that maybe 2 point something. They'd be happy with that. They'd be okay with that. Does that resonate with you, 2 point something?
On headline, for sure, as long as the trend is headed down.
Jim Bianco, Andrew Hollenhorst, to the two of you, thank you. Moments away from that news conference with Chairman